Suppose we have a company, Patriot Theaters. They own and operate 145 movie theaters in the Mid-Atlantic. And it's a successful company. They're in Maryland, Virginia, Delaware, Pennsylvania, and they've identified a fantastic opportunity. They think it is value enhancing to expand into New England. The problem is it's really, really expensive. They don't have enough money in the bank, and they don't, just from operations, won't have enough money to be able to go in there and buy the land and build the theaters and get the ushers outfits and the popcorn makers and the buttering machines and the cardboard boxes for 3D glasses and all the different things you need for a movie theater. So one way that they can get that money is by borrowing, which is referred to as debt. They can borrow money, and that's one of the ways that they can raise the money. What are some of the key characteristics of debt? Quite simply, creditors, it's another name for the lenders, they give money to the firm, and what do those lenders get in exchange? They get promised payments according to a particular schedule. So investors give the firm money, and the firm says, we will pay you this much money at this point in time or these points in time. A couple interesting characteristics. Number one, if the firm does well, payments do not increase. So suppose you borrow money and you're one of the ones who lend money to Patriot Theaters, and they expand into England, and it's fantastic. It is successful. They've got tons of money, and let's say they owe you $100. They would say, hey, thanks for the money. Even though we've got a ton of dough, even though this is an incredibly successful project, you're getting your $100. You're not getting 101. You're not getting 110. You're getting the 100. On the flip side, there is a risk, and it's called default risk or credit risk, that some or all of the promised payments may not be made. So suppose the expansion to England isn't successful, and now it's time that they owe you $100. They don't have the money. They can say, sorry, we can't pay you, and you may not get all your money. However, if they do that, that is a big, big, big deal, and as a result, the creditors, the lenders, they have legal recourse where they can try to secure payment. A typical one is to form the first firm into bankruptcy. So if I go to you and say, look, I'm sorry, I can't pay the $100 that I owe you, you have legal recourse as ways to try to get that money, and typically force the firm into bankruptcy, and often they might sell their assets and do whatever it takes to try to raise money so that you can get paid. Big one, lenders don't own the firm. Little control over it. They do not run the firm. Very little involvement in actually running the firm. Very, very little control. And one of the things about it is that the interest paid on debt is tax deductible, and it's considered a business cost. So it is considered an expense, and it has implications as far as lowering taxes. One of the ways that borrowing can be done, there's a lot. You can go to the bank, you can find a wealthy person. Sometimes firms may go to an insurance company, but one of the big ways is by selling or issuing bonds to investors. And again, the basic transaction, the firm gets cash, the investors, they get bonds, and the bonds entitles them to certain promised cash flows. So at certain points in time, the bond has written into it when the investors will receive the cash flows, when the firm will make those cash flows. Primary market. The primary market is the sale of new securities by a corporation. So the primary bond market, that is when the company sells the bond to the investor, the money goes to the company, and the company raises the money. So once they're sold on the primary market, they're out there, the investors own it. When the investors trade among themselves, that's the secondary market. So it's previously issued securities. And when that happens, the issuer, like the company, gets no money. So basically investor A and investor B, investor A sells the bond to investor B gives money to investor A, the firm gets no money. The only time the firm gets money is on the primary market. Again, we've talked about it. A bond, it's a debt security. There the issuer has to make specified payments over a given length of time. Specified payments over a given length of time. Those have special names in bonds. The payments, there's two types. One is the principal. If you lend money, you want to get your money back. And second, there's a cost to borrowing money, and that is interest. So if you are an investor and you are a lender and you lend me $100, you're going to want your original $100 back. But as we've as with time value of money, you guys know that $100 today is better than $100 in a year. So there's going to be some cost in the fact that you have to delay consumption. There may also be some risk associated, and that gets incorporated in the interest. There's a cost to borrowing money. We talked about the length of a given time. When that happens, that's called maturity. Maturity is the point in time in which me, the borrower, or the firm, the borrower, whoever it is, will have fully met the obligation. All interest will be repaid and all principal be repaid. And maturity is specified. The bond is like a contract, so it specifies this is when the bond matures and this is when certain payments are due. Face value, it's also called par value or principal value. It's the amount that's repaid to investors at maturity. At maturity, there's also interest payments, and those are separate. And what's frequently the case, and firms really try for this, is that the face value is the amount initially borrowed. So if I borrow $1,000 today, then at maturity, when I repay that face value, I repay that $1,000. The interest, it's called a coupon. And the reason it's called a coupon is back in the day, before things were all done electronically, at the bottom of a bond, there were literally coupons that would specify payments and dates, and the investor would clip those and mail them either to the firm or the bank that was managing the bond issue for the firm, and then they would receive a check in the mail. Often semi-annual. Often every 6 months, the bond will make a coupon payment to the investor. So now we're going to look at a couple of terms. The first is the coupon rate. And again, notice that's the annual coupon payment. So how much gets paid in coupons over the course of 1 year divided by the face value of a bond. That's the coupon rate. So suppose we have an example with a face value of 1,000, and we'll make a point in a moment, but in face value of a bond is typically 1,000 in this class, is often 1,000 in this class. We'll always have our bonds be $1,000. Make semi-annual payments of $50. So what does that mean? It means every 6 months it pays $50. So if it makes $50 payment every 6 months, how much does it make in a year? 2 times 50, which is 100. Coupon rate is 10%. And what often is printed on the bond is the coupon rate. So often you'll have 10% printed on the bond, and it's specified. You have the face value that's also printed on the face, and so you can figure out the total annual coupon payments as just the coupon rate 10% multiplied by par of 1,000, and you get 100. And in this case, since it's 2 per year, each one is 50 every 6 months. So that's the coupon rate, and that's stamped on the bond, and that's established, and it's set. In the case of a fixed rate bond, which is what we're going to be assuming in this class, which we'll talk about in a moment. Second term, current yield. Again, total annual coupon payments, but now instead of dividing by the face value, we're dividing by the price of the bond, which is the present value of the market. What is the value of the bond? It doesn't have to be 1,000. It's the value, which is something else we'll talk about later in this on the topic of bonds, not in this discussion. Is the value of a bond is like the value of anything else we talk about in finance. It's the present value of the expected cash flows. So suppose we have a bond that has a price of $900. Semi-annual payments of 50, so it's 100 per year. Its current yield would be 11.11%. $100 coupons per year divided by $900 price. So again, you get the total annual coupon payments from the coupon rate, and you can back out the price as taking the total coupon payments and dividing by the current yield. And so again, if what you have is current yield equals annual coupons over price. So if you multiply both sides by price and divide both sides by current yield, you wind up with that. I think it's easier to see in a formula than it is in the sentence down here. The final rate that we're going to look at is yield to maturity. It's the rate of return on a bond. And so basically, if all payments are made and it's the discount rate that equates the price with the expected cash flows, a good way of thinking about it is the expected return on the bond. And where does it come from? It is based on the risk of the bond. The greater the risk of the bond, the higher the yield to maturity. Lower the risk of the bond, the lower the yield to maturity. Again, all else equal. So again, basic idea, you have a bond that's considered very risky. Investors are willing to invest in it, but they want a high reward, a high expected return. Likewise, if you have a bond that's considered relatively safe, investors would say, we don't need as much compensation, we would accept a lower expected return. And in this class, we assume the flat yield curve. And so that means that all bonds with the same risk and the same coupon frequency, meaning if you're comparing semi-annual bonds with semi-annual coupons or bonds with annual coupons, regardless of the coupon rate and regardless of the maturity, they'll have the same yield to maturity. So again, in the simplified world we've created, when you're trying to compare or evaluate the risk of bonds, that is kind of code for look to the yield to maturity. Whichever one is higher is riskier. A typical bond, these are the kinds that we're going to look at in this class, has regular coupon payments and par value at maturity. So again, you got coupon, 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 and then at maturity, you not only get that last coupon, you also get par. So a couple of notes. We're going to treat coupons as fixed. In the real world, they can be variable, but the large majority of them are fixed, which is where the coupon rate basically stamped on the bond, and that determines how much gets paid in a coupon, and it's that same coupon every period. Variable means that the coupons they can change. Usually they're based on some formula that's tied to some market rate that can fluctuate. We're going to treat things as fixed. That coupon is set. Second, we're always going to assume the next coupon's in one period. If it's semi-annually, it's in 6 months. If it's annual coupons, it's in 1 year. And again, it's just to simplify things. Of course, let's say we have coupons that are paid every 6 months. In the real world, there's only 2 days a year when the next coupon's in 6 months. But if you in order to actually get the price of a bond, if let's say the next coupon's in 3 months and then 9 months and then 15 months, you would actually do everything we're going to be doing in Finance 301 and then add one extra step. We're just focusing on the part until the extra step so we can really focus and understand the fundamentals of what's going on. And again, bond is typical bond. So again, nothing, it's just, basically, as we'll see, it's, if these are fixed, we're basically looking at a nice annuity because the next payment's in one period and it's fixed for a finite number of periods with an extra payment at the end. That's how our bonds are going to look in this class. Also, the par value is always going to be $1,000, and we're going to assume the amount initially borrowed is par. Again, none of these assumptions down here are really that far from the vast majority of what goes on in practice. There's a lot of issuers besides corporations. We're focusing on corporations, but the biggest issuer of bonds is the U.S. government. Treasury bonds, notes, and bills, and the big difference with those is the original length of maturity. There's also an interesting kind of security TIPS, which is where the return actually varies with inflation. So the higher inflation is, the higher your return. So if inflation's high, things are going to get more expensive, but you're going to get a bigger return. So if someone's worried about inflation, that's a nice security. Political subdivisions like states, counties, cities, and special bodies and agencies also create issue bonds. Those are called municipal bonds, and there's a lot of those out there. Folks often will be asked, if you're going to raise money for schools or parks, you get asked in a bond referendum at the election time, and if it gets approved, the county or the city or whatever was relevant for that will then be authorized to go out and borrow to do the schools or the libraries or whatever it was. And finally, foreign countries can issue all kinds of bonds. The Japanese government, European governments, and African, Latin American, governments from all over the world can issue bonds denoted in all different kinds of currencies. So we focus on corporations, but there's lots and lots and lots of other bond issuers out there. And finally, corporations and governments, they can sell bond issues repeatedly. But so at any point in time, there's lots of different issues outstanding. What's interesting is, suppose Patriot Theater goes out today, and they have, a bond issue, and it's out there. And 2 years later, they want to issue some more bonds. They would go out and do that. But these bonds, even though they would still be Patriot Theaters, would be typically quite different. They would tend to have a different coupon rate, a different yield to maturity. They would have a different time to maturity. And even though they're the same companies, they often have different characteristics that will lead to things being different. So companies like a Ford Motor Company that has lots and lots of bonds out there, if you look, they have all different kinds of bonds with different coupon rates, different maturities. They've raised different amounts of times, different amounts of money at the different times. And so that's one of the features of bonds. That just because it has a particular company's name on it, you need to look more deeply, because you can have different bonds from the same company or the same government that can be quite different as far as the level of risk or the time to maturity.